So we'll talk about the distinction between stock splits and stock dividends. So with a stock dividend, each shareholder gets additional stock. It's a substitute for a cash dividend, and it's small enough that the market price is relatively unaffected. So stock dividends do not result in a change in the par value of stock. Stock splits, however, reduce the par value of stock and usually also reduce the market value of stock. Sometimes companies will issue stock splits because they think their market price has gotten too high and they're looking to lower it. So this is an example of the effects of different kinds of stock dividends and stock splits. So all three of them have zero effect on the total stockholders' equity. Stock dividends increase the amount of common stock. Small stock dividends increase the amount of paid-in capital. And stock dividends, both small and large, decrease the amount in retained earnings. In every case, the number of shares outstanding increases. Stock dividends have no effect on the par value per share, but stock splits decrease the par value per share and then often decrease the market value per share. Let's look at an example of a cash and stock dividend. So we have 100,000 shares of common stock outstanding. During the year, we distributed a 10% stock dividend and also paid a 50 cents per share cash dividend. So the first thing we're going to do is calculate the number of shares outstanding at the time of the cash dividend and then the amount of cash required to pay the cash dividend. Well, if we had 100,000 shares before the dividend and we issued a 10% dividend, when we want to know how many total instead of just how many additional, we're going to take it times 1.10%. That tells us that after our stock dividend, we now have 110,000 outstanding shares. We take our 110,000 outstanding shares times our 50 cent per share dividend amount, and the total cash required to pay that dividend is $55,000. Then we look at the statement of retained earnings. This is also sometimes called a statement of stockholders' equity. So we know that this is in addition to our balance sheet and income statement and a statement of cash flows. The statement of cash flows we're going to look at next week in chapter 13. So our statement of retained earnings or statement of stockholders' equity shows what our retained earnings are. Remember, we start with our retained earnings, we add retained earnings, then we're going to reduce any dividends that we have, and that gives us our ending retained earnings. We take beginning retained earnings, add net income, subtract dividends, and that gives us our ending retained earnings. For this example, we want to say, make a statement of retained earnings. We have this company, we have our beginning retained earnings of $460,000. Then it gives us a lot of different information about the company. One of these things is that we had an overstatement to the prior year's net income of $65,000. This can happen from a lot of different reasons, and when it happens, a company just needs to disclose it and say, hey, we noticed this happen. They might say in their notes, we changed our method of depreciation, which then gave us a different cash savings or other kinds of things, but because of that change, we either understated or overstated our net income. So we're going to make a new adjustment to that. So if we're going to make our statement of retained earnings, we start with our retained earnings. At the beginning of the year of $460,000. Then we're going to correct prior year income. So we need to reduce our income by $65,000. That gives us our restated beginning retained earnings of $395,000. Then we add our net income, $250,000. The next thing that we're going to do is deduct dividends. We have both preferred dividends and common stock dividends. So our preferred dividends, we have 10,000 shares times $1 per share for 2 years, because it says that we have $1 per share for the current year, and then we also have $1 per share in arrears. So we have to pay 2 years of preferred stock dividends. So we're going to pay $20,000 out in preferred stock. Then we have common stock dividends. We pay 50 cents per share on 200,000 shares of common stock outstanding. So that's $100,000 in common stock dividends. This gives us our retained earnings at the end of the year of $525,000. As we saw in that example, we had a prior period adjustment. So because our net income is part of our retained earnings account, any time that we find that we had errors in net income, we're going to make changes to retained earnings. The correction gets called a prior period adjustment, and we would show it net of any income tax effects, whether we would have increased income tax effects or not. And we would post a note in our financial statements stating exactly what caused us to have that prior period adjustment. We have this example here of a prior period adjustment. So in this case, we had an error in recording depreciation expense, and they're showing it net of a $15,000 income tax expense, which then is going to restate their beginning of the year retained earnings. We rarely see these prior period adjustments in the financial statements of large publicly owned corporations. One of the main reasons for that is because these errors are going to be found in an audit, and those are going to be corrected before we even print our financial statements. So it's only going to show up on financial statements of corporations that don't get audited on an annual basis. Now remember, only publicly traded organizations are required to have a yearly audit. Other corporations may choose to audit whenever they decide to audit. Some of them will do it yearly, and some of them will not. We can also restrict retained earnings. So what might be restricted can be for a variety of reasons. We might have an agreement, or we might make a decision to do a capital investment of some kind. So we might be planning to build a new building. And so we will say 10% of every year's retained earnings are restricted until we save enough money for this capital investment. Or we might have an agreement, maybe with a bank, that says we can take bank loans out as long as we always have $100,000 in retained earnings. That's a type of collateral that the bank wants us to have available. In that case, we could never let our retained earnings drop below $100,000. So if we had $105,000 in retained earnings, we would be limited to a $5,000 cash dividend because of that contractual agreement. Those are items that would be disclosed in the notes to the financial statement. As you can see throughout this entire semester of accounting, the notes to the financial statements can be fairly long. The average annual report is about 100 pages long. 3 to 5 of those pages are financial statements, and the rest of those pages are composed of notes to the financial statements. We've already talked a little bit about the stockholders' equity section of the balance sheet. We've prepared stockholders' equity sections of the balance sheet. I'm just going to talk a little bit about some of these areas. So we can see that we have a 5% preferred stock. Now, when it says convertible preferred, that means that those preferred stockholders have the option to convert from preferred stock to common stock. We also have our common stock and we have additional paid-in capital. We see that we have an increase in our additional paid-in capital this year from stock dividends. And then another item on here is that we have treasury stock. Now, if you'll remember when I said that treasury stock is stock that used to be outstanding that the company bought back from the marketplace. That is called treasury stock. We don't just reduce the number of shares that we have outstanding. We record that in a separate area called treasury stock when we purchase our stock back from the marketplace. So we're going to look at this example, and this example asks us to prepare the stockholders' equity section of the balance sheet given this amount of information. So the first thing it tells us is that we have 700,000 shares of common stock outstanding. And we distributed a 10% stock dividend on those 700,000 shares. So the very first thing we have to do is record our common stock. After a 10% stock dividend, we're going to have 770,000 shares outstanding. So 10% of 700,000 is 70,000, which gives us our 770,000 shares. We would keep that par, $5 par, giving us a total in our common stock account of $3,850,000. We have additional paid-in capital on our common stock. So it tells us that our stock was selling for $12 per share. This was the market value on our 10% stock dividend. The outstanding shares were originally sold at $8 per share. So then we have to calculate what our original shares were at and what our new shares are at in our additional paid-in capital. So our additional paid-in capital amount is the price over par. So we have 700,000 original shares times $3. And where we get that $3 is because we had an $8 per share selling price and a $5 par value. So we take 8 minus 5 to get 3. So we have 700,000 shares at $3. And then we're going to add that to the 70,000 shares we just added. And that we're going to take times $7. That's our $12 per share selling price minus the $5 par value. So we take that times $7. That's how we calculate our additional paid-in capital amount, $2,590,000. The next thing we have is retained earnings. So we have the balance in retained earnings before the declaration of the stock dividend, but after the addition of the current year's net income was $995,000. So what is left in our retained earnings account? Well, we need to remove the value of that stock dividend. We paid $12 a share for those. So 70,000 shares times $12 gets removed from our retained earnings, leaving us a balance in retained earnings of $155,000. That gives us a total stockholders' equity of $6,595,000. Now we're going to look again at a couple of the journal entries for cash dividends. So here we have an example. We declared dividends in the current year. So we have current year's cash dividend on the 6% $100 par value stock. We have 100,000 shares of outstanding par value stock. Then we have a cash dividend of 75 cents per share on the $10 par value common stock, with 750,000 shares outstanding. So we need to determine what the total amount of our dividend is. So we have 100,000 shares of preferred stock. Our 6% of $100 is $6. So we have to pay $600,000 to our preferred stockholders. For our common stock, we have 750,000 shares times a cash dividend declared of 75 cents per share. So the payment to our common stockholders is $562,500. Our total dividend amount is $1,162,500. On the day that we declare the dividend, we record a liability. That liability comes out of retained earnings. So we're going to debit retained earnings for the amount of our stock or cash dividend. And then we're going to create a dividend payable for that amount. On the date that we pay that amount, we will debit the dividends payable for $1,162,500 and credit cash for that payment. Now the last entry we're going to look at, the last example for Chapter 12 that we're going to look at is stock dividend journal entries. So stock dividends, remember, are not distributed in cash. So we just record them at the time that they're declared. So at the time that they're declared, we're going to remove that amount from retained earnings. So we need to determine what that amount is for. Says that we declared a 4% stock dividend on our 750,000 shares. So if we take 750,000 outstanding shares times 4% times the market price that we have to buy them at for $17, we get a stock dividend of $510,000. Then we need to determine what the common stock par value is on those shares and what the additional paid-in capital is. So we take our 750,000 shares times 4% times our $10 par value, and that equals $300,000. and then our 750,000 shares times 4% for the amount of our stock dividend times the original selling, our additional paid in capital, which is our market price minus our par value for $7, and we get $210,000. So on the declaration date, we're going to record a journal entry to declare the stock dividend. We take the total amount from retained earnings. So we're going to debit retained earnings for $510,000. Then we're going to credit our stock dividend to be distributed. I can't spell. Of $300,000, which we calculated above, and our additional paid in capital, $210,000. So that is the journal entry for the date of declaration. On the date that we distribute that stock dividend, then we're going to debit stock dividend to be distributed and credit common stock. And that is the end of Chapter 12.